I'm so glad we're doing this because I think the reason why people fail at bots, EAs, copiers, manual trading, Top Step, everything else is we're trying to do too much. We're doing too much. Has anybody seen this? See how the best investors invest. Follow the footsteps of the world's best investors and explore their portfolio. Warren Buffett, and remember, take this with a grain of salt. We don't know how accurate it is. There are other aspects, but Warren Buffett, 12% last year. I can help you guys get 12% this month. Accurately, safely, and reasonably 12% this month. 12% last year. Obviously, it doesn't have much leverage, so that's definitely a factor. Michael Burry, negative 26% last year. Kathy Wood, something I super love. I love some of her principles, 15%. I can't believe she's got Roku on here, though. I didn't know that. That's ridiculous. I don't know why she's got Roku on there. All right. I couldn't help it. Ray, well, we know that name, 1.1% last year. Lilu, I don't even know who that is, you guys. Negative 3%, 16%, 6%. And remember, this guy obviously takes the cake. This girl, Michael Burry, Ray, they take the cake. They're at the top. But this might be their first beginner's year when it comes out looking amazing. I don't know some of these names, obviously. 0.26% last year, a $60 billion portfolio. So before you guys keep undermining, oh my gosh, I won or lost 7%, please recognize that if you can maintain at the end of the month with wins, losses, dips, and everything else, a 7% in a month, you have beat every single person on this list. Every person. 9% last year. He's got 38 billion under management. Sam's Capital. Beast. Now look at some of the stuff they're invested in. I love this. I geek out on stuff like this. Tiger Global is only 16 billion, 20%. If I decide to continue to pursue this, I'm going to put my name on this list. There'll be a company that I'm on this list, but we'll see. I can beat these guys. Beat them.
And they pay their fees too on top of that.
Yeah. Oh no, the fee. I'm wondering. I would assume that they're legally allowed to report this. Well, negative is obviously a flip side because in theory they're paying the company, but the performance shouldn't include that. So I'm guessing that this 20% is not including what their fees are or not. But I can't swear to that. Negative 88%. Where's that at, Rika? That wallet is gone.
It's huge to imagine, like if you, well, I guess it depends how long you've been, because if you've been in the market for decades and then you have a 28% pullback on the year, then that, in the short scheme of things, that's not as much. But if you're just, getting started, or if they haven't had like really big performances overall on a regular daily basis, yearly basis, annual basis, or whatnot, that 28% is a pretty big chunk out of your portfolio.
It is, but look at what, I think that goes back to what he said, and don't quote me on the numbers. I'm sorry if I'm wrong, but what was it? NVIDIA, 38%, right, is the amount that it had gained. Okay, but it dropped 38%.
Yeah, dropped 38%, giving back all of about a 38%. Well, it was a bigger percentage rise because it'd be based on a different number. NVDA.
There we go. Wow, how can I do this on my tablet? It looks better. So max all time. So even with that 38%, it doesn't really matter though, right? It really doesn't. Does that look like a blow? If we look at the day, oh my goodness, yeah, that hurts.
Yeah.
But take a look. That's a horrible. I think I look at the 5 years. I'm not all time because
there was something else that I was going to bring up earlier, and that was that people made a big deal out of Warren Buffett selling off Apple shares. He was selling a significant chunk of his Apple, I think half of it. And if you look at what his portfolio is, the most heavily weighted stock in his whole thing was Apple. So Apple's been on a tear, and he's just rebalancing. He's still holding Apple, but he's just putting it in balance with other things because you never know which stock is going to be moving.
Yeah. And these funds have to be very aggressive with rebalancing all in because they need to limit any potential losses or overexposure on a regular basis. Um, even when Kathy Wood, Tesla's always one of the ones she's always been most bullish on. And, once they get a certain amount of gains, and they'll adjust their portfolio and get out of some of those positions. And then when the price is at a more, I guess, digestible price, then you'll see them sometimes hedge back in. And then also too, if they are expecting things with the economy, then they may move those positions into companies that they feel will do better in recession type of or recession like environments as well. The other thing though, for like us personally, like just when Jenny was saying that even beat these numbers, sometimes a lot of people make investing a lot more difficult than what it really needs to be. If you have the big overall picture, you find your few companies that me myself, unless you do an ETF and you're doing that as a very safe one, and you have a lot of money, or you're not going to take money out for like years, like we're talking about like retirement or whatnot. I feel it's better if you're investing personally to just pick a few companies that you're very, strong on, and then just invest in those over a 10-year period or longer. Just continue putting money in. And then when the markets look like this and when there's blood in the streets, just keep investing more if you have extra capital. If not, then just sit on it. But if you look at most companies, hardly take a loss on anything. I mean, for goodness sake, somebody could have invested into Chipotle for the last 10 years and became a multi-millionaire. It's just by being consistent and putting into it. If you look at all these stocks and you look at that, even when they have pullbacks and it looks extreme in the time when it's actually happened, you look overall and you zoom out, you'll see that the company has always been profitable over a course of years, and you're making, 10, 15, in certain cases, 200, 300% on your gains over a longer term period.
I love that. I gotta point this out too. Like, there's so much to be said. Just study this. He's down again. Arguably one of the best investors in history, right? Arguably, whatever, agree or disagree. He's down in this by 50%. He increased his shares.
That entry price of $75 is the average entry price. So that's his average buy. So he's certainly bought some higher and he's certainly bought some lower.
But this should give you a pretty net accuracy. So he's down by 53% on average from everything he's bought to what he has. To my understanding, which is not the NLBL, this should be pretty accurate, this portion.
Yeah, and what he looks at is he's a value investor. So he's saying that at this price, this stock is a good buy and it's going to pay me long term.
And even he said recently, or I don't know how recently, he said if he were to, sell everything or pass it on to whoever, and he would tell them just invest in the SPX. That's it.
Yep. He's saying for the average investor, if you can't follow everything that I follow and everything else, but you look at that, about half of his portfolio is Apple.
But not just that. His 3-year performance is this fourth in 3 years, he's made 19%. So the 1 year performance is 12, 3 is 19. 5 is good. 10-year performance, obviously grand. You guys can honestly do that. Okay, this is not that hard. I don't know. I'm gonna do the math. Let me get out a calculator so I don't put my foot in my mouth. Okay, so 12 times 10, it's 120 months, right? In order to get 17%, what do you need? Like 1.5%? 1.5% a month?
Now, the other thing to remember is that it's much easier to get numbers better than that with the kind of account balances that we have.
I'm so glad we're doing this, because I think the reason why people fail at bots, EAs, copiers, manual trading, Top Step, everything else is we're trying to do too much. We're doing too much. We're trying, and I get it, that $10 is not very sexy. And somebody posted something, and I went back to look, I was like, $10 is 1%. You made 1% in 3 hours. Like 1% is, you've done well. Call it a day. I know you're not going to go buy a Maserati with that. And I know that's not like your supercar money, but I promise you, if you keep at that for 3 years, it's your supercar money. That's what it is. And better yet, if you keep investing, you pay off your debts, because debts are 24% a month. Back to the crypto, you sell when it's high, you just made your 10%. You buy back when it's low, you made another 10%. In the interim of time, you put it in a 5% place. So basically, you're only holding for a couple of days there, and you still made a couple $100 there. You just keep doing it over and over and over again. Like, okay, totally doable. But look, I'm really curious about that though. So in a year, and if we did the same thing, we went to, what is it, XPX, right? SPX ticker, Knox, easy. XPY, I think is better. Yeah, it is. That one's established like a trust. So it's almost 200% of XPX. Established like a trust. That means in 5 years, you still make quite a bit of percent per year. Hands free, no thinking. You can be a little smarter, buy it when it's a debt, preferably, right? Or at least do your best. But that's just averaging out. That's crazy. All right, we're gonna take a look at Kathy Wood just because I can't leave the page without looking at Kathy Wood.